Facebook's Meta went on a 10% freefall yesterday, even after the company announced better than expected earnings. This being said, yesterday's sell-off ended up being less than suggested in the after-hours trading. CEO Mark Zuckerberg said that, in the past, the company also experienced high price volatility during a period of investment when the results were not yet visible. Meta could successfully turn its AI investments into profit, it's just that it will take a bit longer than expected. All in all, some investors think that Meta is worth buying at the dip. The question is, where's the dip? One positive news is that Meta didn't pull the rest of the tech stocks down with it yesterday. Nvidia gained more than 3% while Tesla jumped another 5%. Don't ask me why. On the macroeconomic stage, the news was not bright. The first estimate for the US Q1 growth showed that the US economy slowed way more than expected in Q1. A soft print could have at least revived the dovish Federal Reserve expectations, but the notable jump in core PCE prices to 3.7% from 2% printed a quarter earlier didn't give much room for optimism. Yesterday's data threw a wrench into the soft landing dream and sparked fears of stagflation, where the economy slows down while inflation persists, which would force the Fed to keep its policy tight. The US 2-year yield continues to test the 5% mark to the upside, as the 10-year paper yields near 4.70%. Today, all eyes are on the US core PCE print for March, which is expected to decline to 2.6% from 2.8% printed a month earlier. The fear is to see a higher inflation print, of course, which would further batter the Fed cut expectations. But the good news is, it looked like yesterday's price action already embedded today's core PCE print. Therefore, bad news are, at least, partially priced in. Diving a bit deeper into yesterday's GDP print, the slowdown was mainly caused by a lower inventory accumulation and a wider trade gap. But a gauge of underlying demand still came in above 3% for the third straight quarter. The latter explains why we see inflation persists as the headline GDP slows down. In conclusion, inflation, which slowed last year thanks to fading post-pandemic boost, is now fueled by still robust demand. And that's something the Fed could address by keeping its policy tight. Swap traders now price in 35 BP cut for the entire 2024, down from 6 rate cuts priced in at the start of the year.